How the stock market actually works. The stock market is one of the most misunderstood systems in the world. Some people think it's gambling, others think it's only for the wealthy, and many people invest in it without ever understanding how it truly works. So in this video, we're breaking it all down. Let's start with the basics. At its core, the stock market is a place where ownership in companies is bought and sold. When a company wants to grow, it needs money. It can borrow money or it can sell ownership in the business. That ownership is called stock. When you buy a stock, you are buying a small piece of a company. You are now a shareholder. If the company grows and becomes more valuable, your ownership becomes more valuable too. If the company struggles, the value of your ownership goes down. That's the foundation of the stock market. But where do these stocks actually come from? Before a company is public, it is privately owned. Early investors, founders, and employees own the business. When a company wants to raise a large amount of money from the public, it goes through something called an IPO, or initial public offering. An IPO is when a company sells shares to the public for the first time. This is how companies like Apple, Amazon, and Tesla entered the stock market. Once shares are public, they can be bought and sold by anyone. This is where stock exchanges come in. A stock exchange is simply a marketplace where stocks are traded. The most well-known exchanges are the New York Stock Exchange and the NASDAQ. These exchanges don't set prices. They just provide a platform where buyers and sellers meet. So how are stock prices actually determined? Stock prices move based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. That's it. Prices move because of people's expectations about the future. If investors believe a company will grow profits, expand, or dominate its industry, demand increases. If investors believe a company will struggle, face competition, or lose money, demand falls. The stock market is forward-looking. It's not about how a company performed last year. It's about what people believe will happen next. Now let's talk about why companies and investors participate in the stock market. For companies, the stock market provides capital. Selling shares allows them to raise money without taking on debt. That money can be used to hire employees, build products, expand globally, or invest in research. For investors, the stock market provides an opportunity to grow wealth. Historically, stocks have been one of the most effective ways to build long-term wealth. Not because prices always go up, but because businesses grow over time. When you invest in the stock market, you're investing in human productivity, innovation, and economic growth. But not all stocks are the same. Some companies pay dividends. A dividend is a portion of profits paid to shareholders, usually on a regular basis. Other companies reinvest profits back into growth instead of paying dividends. Investors make money from these stocks mainly through price appreciation. Both approaches can be effective depending on goals and time horizon. Now let's address one of the biggest misconceptions. The stock market is not the economy. The economy reflects jobs, wages, and production. The stock market reflects expectations about corporate profits. That's why markets can rise even when the economy feels weak and fall when the economy looks strong. Markets move on expectations, not headlines. Another important concept is volatility. Stock prices move every day. Sometimes they move a lot. This volatility is normal. Short-term price movements are often driven by news, emotions, fear, and speculation. Long-term returns are driven by earnings, growth, and fundamentals. This is where many investors fail. They react emotionally to short-term movements instead of thinking long-term. When prices fall, fear increases. When prices rise, greed takes over. Successful investing is not about predicting short-term movements. It's about owning quality businesses and giving them time to grow. This brings us to indexes. An index is a collection of stocks that represents a portion of the market. The S&P 500, for example, tracks 500 of the largest companies in the United States. The Dow Jones tracks 30 major companies. The NASDAQ focuses more heavily on technology stocks. Indexes help investors measure market performance and reduce risk through diversification. Instead of betting on one company, you're spreading risk across many. This is why index funds and ETFs have become so popular. They offer broad exposure low costs, and long-term consistency. Now let's talk about risk. The stock market is not risk-free. Companies can fail, markets can crash, prices can fall sharply in the short term, but risk depends heavily on time. Historically, short-term investing carries much more risk than long-term investing. Over long periods, markets have recovered from wars, recessions, crashes, and crises. Time smooths volatility. This is why patience is one of the most powerful advantages an investor can have. Another key factor is inflation. Inflation slowly reduces the purchasing power of cash. Money sitting still loses value over time. Stocks, on the other hand, represent ownership in businesses that can raise prices, increase profits, and adapt. This is one reason the stock market is often used as a hedge against inflation over the long term. Now let's clear up one final myth. You do not need to be rich to invest in the stock market. Today, anyone can invest with small amounts of money. Fractional shares, low-cost brokers, and index funds have lowered the barrier dramatically. What matters most is consistency, discipline, and time. The stock market rewards patience, not perfection. To summarize, the stock market is a system where ownership in companies is bought and sold. Prices move based on supply, demand, and expectations about the future. Short-term movements are driven by emotion. Long-term results are driven by business growth. It carries risk and volatility, but also long-term potential. And when understood properly, it can be a powerful tool for building wealth.